Perhaps I'll ask one, Mohnish. In the Dando Investor, you talk about this concept of arbitrage, and I know it's slightly different than, let's say, when we think of M&A arbitrage. What do you really mean by arbitrage in the business context?
Well, I mean, I think that virtually all businesses that get started uh, are focusing on what I would call offering gaps. So some entrepreneur sees an unfulfilled need, some product and service, and therefore starts a business. And kind of an example I used in the book was, let's say there's a barber in town A, and there's another set of barbers in town B, and these towns are, let's say, kind of 30 miles apart, and there's a new town coming up, town C, which is kind of in the middle of these two towns. And because it's a new town, there are no barbers in that town. Well, some enterprising barber in town A or town C will say, or town A and town B will say, well, I'm seeing some clients come in who are driving in from this new township. I think I can do better if I service them locally because there's no barbers there. And maybe I can charge them more because they save all the driving time. So an entrepreneur is going to see that's a kind of example of an offering gap where town C should have barbers, but because of the growth, it's got a void. It's kind of like what was happening in the fracking areas of the U.S., which were going through turbo growth. I mean, a lot of services were just not available because the growth was so aggressive. And so the barber sets up a small shop. Maybe he leases some space, some secondhand equipment, and is there 1 or 2 days a week. And then over time, he increases his time in the new place as the business comes in. So that type of approach is an approach where the downside is very limited because the barber hardly put up any capital, and he took advantage of an offering gap. And so arbitrage basically, in effect, is the way pretty much all successful businesses get started and formed. I mean, they're going after offering gaps. And if you overlay that on the investing side, there are, so classic arbitrage is risk-free. Kind of, let's say gold is trading when we used to have these different prices of gold in different cities. In London it's at 1,000, and in Dubai it's 1,020 or something per ounce, and you could buy one place, sell the other, and collect the difference and not have anything at risk. That type of approach actually happens in investing as well. I mean, like for example, I think this is going back almost like 14 or 15 years ago. I invested in a steel company called IPSCO, a Canadian steel company, and they had they had $15 in cash per share, and they had contracts where the next 2 years of earnings were going to come in at about $15 a share for each of the next 2 years, and the stock was trading in the low 40s. And so if you just took, and there was no debt, so if you just took the current cash and just added in the next 2 years of kind of contracted cash flows that were high probability of coming in, you basically were getting the entire business for free. So there was an arbitrage there, if you will. And because this business was very highly cyclical, it was entirely possible that after 2 years, earnings was zero or even negative. So that is why the market was pricing it at 2 times earnings. But in effect, I think that was a extreme reaction. And so I bought the stock in the low 40s, and then it drifted up to the 60s in the next few months, and then the company announced they had one more year of visibility, again at $15 a share, and now the stock was close to 90 because you had now a little more visibility, and then some Swedish company came and bought it for 160. So in that situation, it was very difficult to come up with a scenario where you would lose money. I mean, to lose money, what would have had to happen after 2 years is not only would earnings have had to go to zero, they would have to go negative. And of course, the company has a lot of levers they can pull when that is happening. So that's an example of arbitrage. But I mean, what we are looking for, even in investing, is exactly what the entrepreneur is looking for. The entrepreneur focuses on risk-free bets, or as close to risk-free as they can get, and that should be our focus as well. Is look at opportunities where the downside is very muted. Like in the case of IPSCO, I mean, you had contracts, there were these pipelines being built, they needed those steel pipes, and the odds that they could just walk away were pretty low. And we find those are far more common than you would think they are.